So we'll start today. Today's topic is, so in the previous occasion we did payoff profiles and profit profiles. So today's topic is a very important topic, which is positions and synthetic equivalents. We can do it. We can put this in bold. All right, so this is the topic: positions and their synthetic equivalents. Okay, so we're going to be talking about these positions in the underlying asset, puts and calls. So first, we need to define what a synthetic equivalent is. All right, anybody wants to take a crack at what a synthetic equivalent is? Anybody wants to define that? Or what, let's make it more, the synthetic equivalent of, whenever you say equivalent, it's obviously of something, equivalent of a position. Okay. Okay, so remember that a position is defined as a purchase or sale of base asset, and obviously that means a sale or purchase of a terms asset. Okay. So let's say position. Let's first define position. Just as a recap, you will find this in your notes of the material that I could not cover directly with you. So this is purchase, sale of base asset, any base asset. So you can define this definition will always be true for any position: purchase, sale of any base asset, and these assets could be futures contracts or options contracts. So if we have that definition of asset, base asset, we can actually just write this short definition of a position: purchase, sale of any base asset, hence sale, purchase of any terms asset. It should be and purchase. So this should be sale, purchase. So if you're purchasing the base asset, that means you're selling the terms asset, and vice versa. So this will be written as sale, purchase of any terms asset. So if that's the case, purchase, sale of base asset, and for sale, purchase of terms asset. Right. So if we say you're long Microsoft, that means you're long common shares of Microsoft, and you're short US dollars, because here the terms asset is US dollars. Right. So your position is long common stock of Microsoft, whatever number of units, and your terms asset is short US dollars, and whatever the purchase sale consideration is, which you pay. Okay. In this case, it's purchase. We're talking about long Microsoft stock. Okay, so that's your definition of a position. Now, what is the synthetic equivalent of a position? Anybody wants to give us a definition of synthetic equivalent of a position? So if I have, example, let's say, so the example I gave you, long is the size. So position can be either long or short. Okay. So long 500 common shares. So we can take this example on this side. Next line of MSFT. Okay. Implying, if we say at the price is say 200. So implying short, here you have short USD, so 502. I should write it this way so that you know where the number came from. Okay. So $200 each, short 500 shares. So you're long so many common shares at a price of $200. That means you're short US dollars equivalent to this amount. Okay, that's your position. Now the question is, what is the synthetic equivalent of this position? Okay. Right. So here, anybody wants to hazard a guess what a synthetic equivalent is?
Sir, we short dollar for the same amount.
Now here you're already short dollar in the position, right?
Oh, okay, sir.
Yeah, see the position itself, remember that every market has two assets.
Two aspects, yes, sir.
Right? So in any market, if you're long Indian rupees, in the main market for Indian rupees is dollar rupee, you have to also mention the market because you could also be trading Indian rupees against British pounds or any other currency, Swiss francs. So you have to always mention the market. So you have to say dollar rupee. If you're long, long in the dollar rupee market, and the base asset is dollars. Okay. In that case, say if you see here, there are always two assets, right? So if I write USD INR, you see this is the way that it is written. So it's always, we can go to our RD chart view. Okay. So you can see if you're long dollar rupee, in the dollar rupee market, if you're long, here the base asset is US dollars, terms asset is Indian rupees. Okay, so if you're long dollars, that means you're short Indian rupees. So in this case, you're long common shares of Microsoft, and therefore you're short US dollars. So you're already short US dollars, right? So synthetic equivalent is we should write it this way, that positions are always in a particular market. Remember, you always have markets of various types. I just showed you the shares, the market for the common shares of Microsoft, where the two assets are Microsoft shares and US dollars. And now I'm showing you the market for the dollar rupee spot FX. Okay, so here the two assets are US dollars and Indian rupees. All right, so and then we refer to any particular position. We refer to any particular market, and then with respect to that market, we can have two positions. We can either have, and of course we have to also look at the instrument here. What instrument is being plotted? Here, in this case, it's spot. So in spot dollar rupee, then I can have two types of positions. I can either be long or I could be short. And so the long or short already refers to the base asset. So if I say I'm long dollar rupee, that means I'm long dollars. And so if here I can be either long dollars or short dollars. And conversely, I will be long short rupees or long rupees. All right. Now, so I have a position in this market. So synthetic equivalent of position in any market is, let's put it this way. Okay, so let's define it. Okay, so it's very synthetic equivalent. Let me just give you the technical definition first, and then I'll explain the definition, and we'll look at an example which is easy to understand. Okay. Let me put it this way. Let me write it in a more general way. Now you notice instead of writing a position, I'm writing it as a set of positions. That only means that we can have multiple positions. We can have a portfolio as well. And at the same time, set of position also includes one position. Okay. So if I see one student sitting in the classroom and I say that that's a set of students, that statement is correct, because in this case, the set of students has only one element. and that's quite okay. So if I say set of positions, that is sufficient. It covers one position, it covers multiple positions which make up a portfolio. And you can talk about a synthetic equivalent or set of positions. But the positions are always either long or short, and they are always with respect to any market. And in fact, we can talk about this again, market instrument combination. Remember? I'll just write it in. I don't know if this will work, but anyway, synthetic, okay, that doesn't matter. So in that case, I might as well write the property. I wanted to fit everything into one line. But anyway, synthetic equivalent of a set of positions. So you notice how we are writing this. So just to recap some of the fundamentals, okay, we have to always make sure that our fundamentals are correct. Market always involves two assets, base asset and terms asset. Whenever you're looking at any market, it's always some kind of instrument that is involved, okay? Usually for most of the charting that we do, the charting is mostly for spot instruments. And then you can see here, so this is for any market, you will have the positions can either be long or short, and they will be in any market, and they'll be usually, when we plot something, we're always looking at some market instrument combination, which means spot or options or forwards or futures, etc. So, for instance, if you can hear a chart, you can, if you look at CL, okay? CL, they have not crude oil futures. If you look at crude oil futures, which is CL, which you'll be trading in your next project, okay, you can see here, straight away you can see how many crude oil futures can be tracked. You have the January 2021 contract, you have Feb 21, March, April, May, June, July, okay? All of these can be tracked. So therefore, these are different instruments. These are all different instruments because the maturities are different. So you can track all these different instruments, but you'll be always, whatever price you're looking at is always the price of some market instrument combination. Okay, so here this is dollar rupee spot. So synthetic set of positions can either be long or short, and they always have to be in some market instrument combination. Okay, and we say set of positions to include the possibility of more than one position or even of one position. Synthetic equivalent. Now, what is it? What is the synthetic equivalent? Okay, so we define it as this way. So we're now defining synthetic equivalent, a set of positions in any market instrument combination. Now, here, okay, put this on board. Any other market instrument combination. So we are usually talking about, you don't have the, when the synthetic equivalent is not going to be in the same market, okay? And it's not going to be in the same market instrument combination in any other market instrument combination, but only one can, even one differing is okay, basically. Let me, how do I put that? Which is that, so now it's a little bit theoretical when I write it, but I'll write it first. Once I give you the example, we'll discuss some cases. It'll become very clear to you what it is. It's not very complicated once you understand what the idea is. A set of positions in any other market instrument combination okay, So why do I write this? It suffices if only one of these is different. That means when I say other market instrument combination, obviously it means some different market from this one, where the position is. Okay. So we're talking about the synthetic equivalent, and then we're talking about the position. So this is where the synthetic equivalent is what we're talking about, and this is the position that we're talking about. Okay, so the set of positions is one market instrument combination. You need to have a set of position in some other means different from this one, where this is. Okay, so a combination by that here, and so here I'm putting clarification that if only one of these market instrument combinations is different, that's fine. Okay, so for instance, if you have dollar rupee spot, then you have dollar rupee futures, that's fine because of the instrument is different. Okay, so therefore it is sufficient to have one of these as different. Okay, a set of positions in any other market instrument combination that here the word same is important. Okay, so here we're talking, this underlined stuff keeps coming up. All right. So we're talking about a synthetic equivalent, okay? That refers to a set. Equivalent means it's equal to something else, so that something else is a set of positions in any market instrument combination. Now we're saying the synthetic equivalent is a set of positions in any other market instrument combination. Only one of these can differ, either market or instrument, and that has the same economic effect or generates the identical cash flows to the set of positions in all scenarios. Okay? So this is the technical definition of synthetic equivalent. But instead of memorizing this, try to understand it. I'll give you a very crude example. Okay, so here you have two positions. Okay, let's say, or just to understand the concept. Okay, the let's say A. Okay. A is a cup of hot tea with milk and sugar. Okay. So in A you have a cup of hot tea with milk and sugar, right? And so we are going to assume that there is time and effort are not important. Okay. So we're just going to, for the sake of this example, we'll assume that time and effort are not important. So you can remember this example, and hopefully this helps you to understand the idea of a synthetic equivalent. So you have a cup of hot tea with milk and sugar ready for you to drink, and here you have, let's say, so yeah, you have a cup of boiling water, plus you have one tea bag plus you have milk, and then you have a sugar sachet or whatever. Okay, and milk can also be in the sachet. Okay. Now, so what we're trying to say here is a synthetic equivalent. In this case, we say that B is a synthetic equivalent of A, because in this case you have a ready-made cup of hot tea, and if you just ignore, for the sake of this example, we're going to ignore effort. But if you have this, then you can create a cup of hot tea, right? This looks different on the surface, but you can create a cup of hot tea. So you have basically, this has the same effect. So it's not a financial markets example, but I wanted to give you a simple example so that you can understand it easily. It's something else which you can put together and create the same effect as the original position. Okay, so in this case we say that B is a here. Yes, Utsav has raised his hand. Yes, Utsav.
Sir, I have two questions.
Yeah.
Sir, first of all, when we are saying that it has the same economic effect or generates identical cash flows, we are talking in respect to the risk as well, or the risk can be differentiated?
No, here we're not talking about the risk, because we are talking about the, you'll see later on why we don't talk about the risk. Once you understand from here later on, we're not going to cover arbitrage right now. We're going to cover the synthetic equivalence, but when you see that the concept of synthetic equivalence is very related, it's very crucial to understanding what is called classical riskless arbitrage, or what would have been just arbitrage. To understand that, once you understand arbitrage, then you'll understand that the risk is covered. Okay, so the risk is a separate matter. So I would say at this point of time, don't worry about the risk. At this point, we are talking about, when we talk about same economic effect, we're talking about the return part of it, not the risk part of it. But it's a good question, because risk is always important. So I would say at this point, don't worry about the risk. It will become clearer once we cover arbitrage. Okay, but when we are talking in general, to answer your question, is when we're talking about the same economic effect and identical cash flows, we are really talking on the return side, okay, not on the risk side. And you'll see why the risk side is not important, because usually what happens is, I'll just give you a preview of arbitrage. The main idea of arbitrage is that you will look at these two different things. You look at the position and you look at the synthetic equivalent, and you will sell one and you'll buy the other. So you'll have no risk left. Okay, so you'll have effectively very little market risk. There may be some credit risk left, etc. But very little market risk, because you're always going to be buying one and selling the other. So you will have no net position, because remember, this is also going to be a position. So when you have some position, so if this was a position, so I basically, let's put it this way. Let's think about it this way. If I can buy B, for, let's say, 100 rupees, okay? If I can buy B for 100 rupees, then I can contract to sell somebody A for 100. If I don't intend to make any profit, okay, then I can contract to sell someone A for 100 rupees. So usually the way we'd use the synthetic equivalent is in the context of arbitrage, where you would always buy one and sell the other. So I would buy this at 100 rupees separately. Total cost would be 100 rupees for me. And then I would sell somebody a cup of hot tea at 100 rupees. So I don't have any profit as such, but I don't have any loss either. And I don't have any exposure, because I bought I bought the ingredients for a cup of tea, and I sold the cup of tea as well. So I have no net position. Okay. So does that help? Does that give you some clarity, Utsav, based on the question? I mean, regarding the question that you asked.
Yes, sir. Sir, regarding the risk, it is clear. And sir, the next question follows that you told me that if I have a cup of B, if I have option B for 100, I'll sell for A. In the first place, why would I do that?
I'm giving you an example where you're not making any profit. but usually you would make a profit, and that's why you would do it. So your question is also correct in the second part, that why would you do that? So this would typically what would happen is, the reason you would do this arbitrage is you would observe that the market is selling this for 105, and this one you can see that you can obtain this for 100, and the market is selling this for 105. Okay, so you would actually here this would be equal to 100, and here you're selling it at 105, and that's why you would engage in this arbitrage. So the basic idea of arbitrage, we're getting a preview of arbitrage here, is that you look at two things. You look at the position, you look at any position, okay, and you try to imagine if there is not imagine, but try to observe in the market. It has to be something real, okay. So you try to look around in the market and think about it, but you also need theoretical knowledge to understand what would be the synthetic equivalent. You look at any position and you try to look at the synthetic, you try to see if there is a synthetic equivalent for this. As you ask yourself, well, does this position have a synthetic equivalent? And then if so, can I see the price of the synthetic equivalent? So in this case, what you do is you look at this trading at 105, and then you look at the separate prices of all these things, and you see the separate prices, they cost only 100. In that case, you would actually buy this B and sell A. Does this make sense to you now? Is it a little clearer?
Yes, sir. Yes, sir. It means in the end, I have to drink tea only. So I'm drinking tea and gaining a ₹5 profit as well, $5 profit as well. That is why I'm doing it.
Yeah, you're not really drinking tea actually. Somebody else will be drinking the tea.
It's just an example, sir. If it was that case.
No, I'm saying even in this example, somebody else is going, you are pocketing the money. You're not drinking the tea. Somebody else is drinking the tea. You're selling the tea to him at 105, and you're buying, if you sell him the tea at 105, okay, that means you will receive 105 rupees, and you will have to give this cup of tea, okay? So this is the exchange that is happening in the cup of tea market. Two assets, you have a cup of tea on one side, and you have Indian rupees on the other side. So you buy Indian rupees and you sell this. If you sell this, you have to deliver it, okay? You have to deliver on your obligations under the contract. And so how will you deliver it? You don't have this. You can deliver it because you, in this other market, you went and did this transaction. So you have all of this, and then you put it together, and then you deliver the tea, and you create this thing, and then you deliver it to the guy that you sold the tea to, and he will give you 105. And to buy all this stuff, when you bought all this stuff separately, in each of these transactions, you're looking at one transaction, 2, 3, 4 transactions. In all these 4 transactions, you were buying these assets, and you were shelling out Indian rupees. Total comes to 100. So total, your book is going to show, before you sell it, your book is, on the one hand, the costs are going to be this, and the returns are going to be this, and the product is going to square out because you bought the product, you bought the components of the product, and you put them together, sold the product, and so the product book is clear because it's plus and minus, and on the rupee account, you will have a profit of 5. Is this clear, sir? And everybody
Yes,
else?
sir.
Yeah. Okay.
Yes.
So that's basically, so which means you're not drinking the coffee, you're not drinking the tea, somebody else is drinking the tea, you're just pocketing the money, okay, the profit. So this is the basic idea of arbitrage. The basic idea of arbitrage is that you look at a position and you ask if there's a synthetic equivalent, and then if there's a difference in the price, you will do this. Okay, so what you can do is you can refer to the Nattenberg book where we talk about, we can now show you the book. Maybe we should just put it here. This. So here I've said that this book is by Natlenberg. Okay. So this is a practitioner book. It's a very useful book. I would recommend this book. There are certain parts where I'm referring to the textbook for certain things, but I would say even, and I also refer to this in certain parts, but I would say between the textbook and this book, you would always prefer to read this book. It's a much better book. It's a practical book, and it does not unnecessarily use mathematics for dealing with issues. So it's a very good book. So here you can look at, I have referred to synthetic equivalent call preview, maybe 217. So maybe we talk about arbitrage, and we are giving a little preview of arbitrage. Synthetic equivalent of any set of positions is, we're defining a synthetic equivalent, okay? Here, to ignoring time and effort, let me finish this right up, okay? Before I get to. So in this crude example, ignoring the time and effort required to put all these together and make a cup of tea. Of course, you need another one. Okay, so here you need a cup also. Okay, you already have the cup of boiling water. Okay, here we say that ignoring time and effort, synthetic, we say that B here we say B I'm not writing the, actually I should write the, but to save writing space, I'm not writing. We say B is the synthetic equivalent of A. All right. So, okay. So here, ignoring it. Now, this the idea of a synthetic equivalent. Let me just write it. Create a separate subtopic here. Or not like that, not like this level. You hear this word, you might have heard this lot. This word is very badly used, actually, arbitrage. So I will have a separate session on detailing what arbitrage is. But the main thing you have to understand is that arbitrage, the word is very badly, there's a lot of misuse of this word arbitrage. So that even where situations where you don't actually have arbitrage, people are calling it arbitrage. So we have now been forced to refer to arbitrage as classical riskless arbitrage, because people are misusing the word arbitrage. So we are forced to say classical riskless arbitrage, which means the true arbitrage is actually riskless and it leaves you with no position. If you see here, I buy this stuff in the market and I sell it at 105 and I pocket the 5 rupees difference and I'm left with no position because I'm long here and I'm short here, and long and short cancel out because they're the same position effectively, okay? And they're canceling out, the position side cancels out, and then on the P&L side, on the terms asset, remember, P&L is always in the terms asset. So in the terms asset account, the P&L shows me a profit, okay, 5 rupee profit. So here synthetic equivalents, so in classical riskless arbitrage, you don't have any risk. And I do these instantaneously so the price doesn't move. So I lock in the profit, okay? So unless somebody defaults on the contract, one of my counterparties, then, so this guy drinks the coffee, drinks the tea, but doesn't pay me the money, then I lose, then I have a problem, but that's a different kind of problem. That's a breach of contract problem. It's not a market risk problem. So in a classical riskless arbitrage case, you have no position left, you have no position, you have no risk, and that's the only case where we should use the word arbitrage. But industry is not that careful, so industry uses the word arbitrage in a lot of situations where you don't actually have classical riskless arbitrage. Okay? So Therefore, I've just got this one topic, a little subtopic here. Let's put this like this. So let's say that the basic idea of arbitrage, we'll just introduce it here, that because once you understand arbitrage, you will also understand arbitrage-free valuation. If you remember, we have talked about arbitrage-free valuation, which we have not explained yet, but that's because we haven't explained arbitrage first. Once you understand this, then you can talk about arbitrage-free valuation. Synthetic equivalents are crucial to understanding and executing arbitrage strategies. Okay. So here at arbitrage strategies, what I will do is I'll also refer you to at this point, I will refer you to Nattenberg's book. Okay. I'll refer you to what book, what page. Should we make it? No, let me use this one where there's a Nattenberg reference. Yeah, 217 in the book. Okay, so okay, double bracket here. Let me refer you to this part here so that you can do some reading also in the book if you want, if you get confused. And this is a very good book to read. So Nattenberg, let me make sure this is the right page number, okay? I'll just refer you to the start of the chapter. Okay, let me see whether 217 in the book, it will be something else here.
Sir, it is 213.
213.
Yes, sir.
No, bull and bear spreads means it's already gone to, it is in the previous chapter. No, I think it's two.
As per the PDF, it is 222. I was going up with the chapters.
Yeah, this now we have gone to chapter 11. So here, so you see this thing called option arbitrage. Okay, let me increase the font size. Let me increase the zoom a little bit. Yeah, so you have this chapter on option arbitrage that starts actually on, I think, in the book 213. Okay, it starts on page 213. So when I say in the book, I mean this. Okay, on this page is 213. So when I say in the book, there are some references where I've said in book. In book means that when you look at the page number, so this will be different. This is showing 222, but here I've written as 213. So in book, I'm just giving the in book reference because that's the safer one, I think. So this is 213. Okay, you can refer to this option arbitrage chapter to understand to get some flavor of arbitrage. Okay. And then you can read about, and here you can see they're immediately starting with synthetic positions, because when you want to understand arbitrage, what you have to do is you have to first understand what is a synthetic position. So synthetic basically is, and I've made it easier for you to understand by using the word synthetic equivalent. Okay. So just keep this here. You can come back to this and then refer to page 213 in the book as a reference. So synthetic equivalents are crucial to understanding executing arbitrage strategies. Okay, and the basic element of arbitrage strategies is so let's use so this Google is so smart. It can help me spell algorithm. Okay. So arbitrage strategy algorithm, or you can say, not happy with the construction of this arbitrage strategy algorithm. Okay, we'll write it this way. Basically, these are the logical steps. Okay, for any For any position, actually we can call it set of positions. I'm writing it in different lines so that it's easier, it's broken up. We understand. For any position or set of positions that you look at, okay. So for any set of positions in any market instrument combination, which we can actually put in brackets because it's always understood that any position has to be in some market instrument combination. Any set of positions, find out if there is any synthetic equivalent. You can put this part in brackets. So usually when we say synthetic equivalent, it's the equivalent of a position. So this is also a position, okay? So just to be clear about that, I'm just writing it like this. When I say synthetic equivalent set of positions, it's like this one here. This is a synthetic equivalent set of positions. It's a set and it has so many elements, 1, 2, 3, 4. So this is a set of positions, okay? And we say that this is the synthetic, B is the synthetic equivalent of A, we write. But actually you can write it even more specifically and say, B is the synthetic equivalent position of the position in A, okay? So therefore, you can write this. So synthetic equivalent is always a position as well, because it's equivalent to a position, so it's a position. So find out if there is any synthetic equivalent position, set of positions, okay? Find out if there's any synthetic equivalent set of positions. If it exists, that means if the synthetic equivalent position exists, now we'll have to call this SE because I don't want to keep writing synthetic equivalent all the time. I'm just going to call it SE, okay? Now, let's call this P, okay? P is the position and SE is the synthetic equivalent, okay? So this is just so that I don't have to write these big words every time. Now, because we are going to now write a little bit of, use a bit of mathematical symbols, okay? If it exists, what is the market price of SE, okay? And because remember, because that is a market, and the P is already a position in a market, so we know what the market price of P is already known because we can observe the market. Market price of P is known. I want to keep this at one line if I can. Yeah, okay. This is actually known, so if it exists, what is the market price of the synthetic equivalent? Okay, we can remove this. It's actually English good English requires that we write that, but I'm going to save some space here on the screen, so I'll remove the So what is the market price? So first find out, so you look at any position and see if there's enough, in order to see if there's an arbitrage strategy possible. What you do, what are the logical steps? You first look at any market, any set of positions in any market. All right, so you can consider both the long and short side. And if you see, but both long and short would be executed at the same market price in this position, in this, in both the markets, in both the synthetic equivalent and the original position. The price, there is a market price, and we assume that there is no bid offer spread difference. In real life, you can adjust for that. And here you look at this position and you find out if there's any synthetic equivalent. It may not exist in all markets. Okay. So first you find out if there is a synthetic equivalent for this position, and then what is the market price of the synthetic equivalent? Okay, and the market price of P is known. Okay, then what you do is, if so maybe we should put this one also A. Right. So if the market price of SE is greater than the market price of P, then what are we going to do? Anybody wants to answer? So if you find that there are two things, you can observe both. You have a position and then you have a synthetic equivalent. You found out these two things and you observe the market prices for these two things, and you find that the market price of the synthetic equivalent is greater than the market price of P. In this case, you should buy which one should you buy and which one should you sell? Anybody? Let's ask Rajat. Yes. Buy what and sell what? Yes. Let's ask. Who should we ask? Let's ask Nikita. What do you think? Buy which one and sell which one? Okay. All right, let's ask Sachin. Yes, Sachin, what should we do? Aman AA has put up his hand.
So we should sell the synthetic equivalent.
Let's see what's it, AA. Let's have Sachin. What is Sachin saying? Sachin is also sleeping. Okay. So AA, okay, go ahead, AA. What is your answer?
So we will sell the SE1 and buy the other one. So synthetic equivalent we will sell.
Okay, good. So he's correct. Okay. Nikita will sell the synthetic equivalent. Okay, good. Okay, fine. So then if we have, as he's correct, so we'll sell the SE and we will buy the market price. So now you'll notice here that you're not left with any position, okay, and you're going to buy this. You're going to buy the thing and you're going to sell the synthetic equivalent. You're going to buy the P and you're going to sell the synthetic equivalent. So because this is higher and these two are the same, So two identical things should the identical thing should not have two different prices. So if you see that, then you can buy the market which has the lower price and sell the market which has the higher price. Okay. So here you buy P and sell SE, and obviously on the other side, there's no question mark here. If you repeat this, then, and in this case, if the price of SE is less, you buy SE. I think it's easier to do this correctly, write it. Buy SE and sell P. Yeah, in this case, because sell is Z. So this you can read this, and you'll find many examples if you read this chapter, the option arbitrage chapter. So this is a separate subtopic that we have introduced. Okay, synthetic equivalence and option and arbitrage, which yeah, we will have a little bit more of a discussion on arbitrage, on what is not arbitrage. We'll give you an example. We'll look at some examples later on. I'll just give you the names here. That what is, so this is actually truly arbitrage. So in classical riskless arbitrage, let's take this here. Might as well actually finish this subtopic, which I thought I would address later, but since we started talking about synthetic positions and I just mentioned it. Which we are going to use CRA now. In future, I'm not going to say this, I'm not going to mention this whole big set of words. I'm just going to say CRA, okay? No net position. That means buy SE, sell B. No net position. Okay? No net position and no market risk. Okay, so when I say no market risk, that means that credit risk can remain. Very bad writing. This is way for intro. And what else might remain? Credit risk and risk of, let's just write, breach of contract. So when you do CRA, it doesn't necessarily cover you for credit risk, it doesn't cover you for breach of contract, but it does cover you for what is called market risk, okay? And now I've not explained, I think I've not explained to you the different types of risk, but briefly I'll just mention that market risk is essentially what you guys are facing right now. You're buying and selling options. In the previous project, you're buying and selling stocks, spot stocks, and you buy something and then it goes down. So that's market risk. Here, if I go short dollar rupee at 73.5, and then the dollar rupee starts rising to 75, 76, then I'm losing money. So this is basically my P&L is getting altered because of the movement of market prices. So that's market risk. And by credit risk is a different kind of thing. Credit risk is when somebody doesn't pay you back. So for instance, what has happened in the case of a lot of these NPAs, you notice a lot of NPAs on the books of India's public sector banks. That's an example of credit risk, where let's say Vijay Mallya's company borrows money from State Bank of India and does not pay them back. So here the loan has to be written off. So that's an example of credit risk. The people who owe you money don't pay you back. and breach of contract you already know from before. So these kinds of risks can remain after you do CRA, but there is no net position and there's no market risk. Okay? And so a profit is locked in. So after execution, you're left with no net position, no market risk. And just to make it clear, just to go back to what Utsav was saying, why would I do it if there is no money for me? Obviously, and a profit that is, we say, locked in. Okay, locked in the sense that you have contracted to sell at 105 and you have contracted to buy whatever you're selling at 100. So if none of these guys default on the contract, then you will pocket this 5 rupee profit. Okay, so that's why we say the profit is locked in. All right, so no net position, no market risk, and a profit that is locked in. So these are the crucial elements of okay, so that's what it is. Now just look at it while I just read this. Okay. Okay, so that's your. So we had a little bit of a topic here. So we started with the idea of positions and synthetic equivalents. So we did a little bit of recap just to make sure everybody understands. Okay, these are the crucial terms: base asset, terms asset. So when you have a position, you have a little bit of background noise. You can just ignore that. Okay, this base asset and terms asset, and then you have okay. So sale, purchase of any. So any position is defined in terms of you either purchase this or sell this, and then you do the opposite here. That's a position. Then you talk about the synthetic equivalent of a position. We talked about that. What is that? It's basically a position is going to be in any market instrument combination. Synthetic equivalent. Okay, so so synthetic equivalent, we talked about that, and then we define a synthetic equivalent here, and then we have talked about a little subtopic, which is that synthetic equivalence and classical riskless arbitrage. So maybe we can just break it up a little bit, but this. And for this, you can refer to this. We had a little bit of subtopic. So we explained what a synthetic equivalent is, and then we explained their importance in arbitrage or CRA. And so I've given you this, and what is the arbitrage strategy algorithm for any kind of arbitrage. This is what you go through this thought process. You look at any position or any market, and then you see there's a synthetic equivalent. And if there is one, then what is the price of the synthetic equivalent? And you can compare that to the market price, and accordingly you would buy and sell. Okay, so then we have the definition of classical riskless arbitrage. And so I'm not going to define these terms here. So we talk about industry uses the term arbitrage to refer, let's put it this way, let's make it very clear. Incorrectly uses the term arbitrage because people in industry are not that careful in terms of conceptual, what are they using, what are the terms they're using, and what are the implications of those terms, using that kind of language for people's conceptual understanding of the theory. So people are not that particular about that, so therefore they use a lot of terms loosely. So uses the term arbitrage to refer to transactions properties. Okay, properties here means not I have some houses in Kampura. Properties here means characteristics. Okay, properties that do not have the properties of CRA. So the reason that we had to if people were not making this kind of mistake, we would not have had to use a new term called CRA, because we would have just used the word arbitrage and nobody would have misused this word. And so every time someone said arbitrage, we would always understand what we have defined as CRA. But because people are using the language improperly, casually, in a loose manner, so we are now obliged to make it clear that there is something called CRA, and all users of the word arbitrage that you see in the industry are not necessarily CRA. Okay, so I'll give you some examples that you might come across, some well-known examples that include this word, and they're actually not CRA. So, but they are legitimate investment strategies, but they're not CRA. Okay, so what are these? I'm not going to explain those terms, but I will just briefly give you the terms so that you know, you're aware of these terms, and you know that these terms are referring to transactions that are not CRA. You should be clear about that. Okay, so what are these terms? Let's look at example. Okay. So we have first example is here ARB stands for arbitrage. Okay, it's not arbitration. It's arbitrage. Okay, so we will copy this and risk arbitrage or merger arbitrage. Okay. So here what you do is you buy and sell stocks of companies that are going to be involved in mergers. If you remember from your previous class, you had EMU. I don't know if EMU is still trading. At least we'll have the stock available. No, what was that? I forget the ticker from the last class, but Immunomedics was what was the company? Maybe it's no longer listed because they got taken over. Whatever it is. So we'll find out. I think it's useful to look at that stock. But anyway, so there's a company that's being taken over. I'm just not going to go too much into that detail right now. Okay, so risk arbitrage or merger arbitrage, basically what you do here is, I'll just briefly mention it and I'm going to write it. Here, you buy the stocks of, you have a view that some company is going to get taken over by some other company. And so you think that maybe Facebook is going to buy Yahoo. Then what you do is you buy the shares of the target company. Yahoo is the target. And you sell the shares of the acquirer company. So you sell Facebook. So that's the idea of risk arbitrage and merger arbitrage. And this is not arbitrage because this condition is not fulfilled. Okay? There is market risk in this transaction, so it's not CRA. Okay, so that's one. Okay. Second is one is risk of merger arbitrage. Modular gap between the lines. Okay, the second example is what we call this is called statistical arbitrage. Statistical arbitrage is quite a legitimate hedge fund strategy. It's one of the most successful hedge funds of all time. Renaissance Technologies, they use a lot of statistical arbitrage strategies, and they trade very, very short term, and they use statistical arbitrage. So this is basically, statistical arbitrage is simply things like, I'll just give you a flavor of it. So you take a company like Ford here, and you say there's another company which is very similar, so we can compare it. We can add, say, General Motors. And so the basic idea of statistical arbitrage is like this. Okay. So I think that, yeah, so GM is here and Ford is here. So you can see they move quite similarly. Okay, we are tracking Ford and General Motors, okay, together. So you find that they're quite similar, but at the same time they're not identical, because for instance here you see that this part going up is not the same exactly. So they move quite identical to each other, in a way that is quite identical to each other. And so what you do is historically you look at what have been the variations, you standardize the price difference between the two, and you look at what is the historical behavior of this differential. Now you're looking at the differential only between the two prices. You can standardize it or normalize the differential for scaling purposes. And you look at the basic idea, try to understand the basic idea. You're saying that Ford and General Motors, say they're same industry, so the prices should move more or less together, okay? So you see how together they have moved in the past, and you see what the minor differences are. And then you look at, if you plot the difference between the two, you can imagine plotting the difference between the two, and there'll be some number, let's say, okay, maybe $2. I'm just giving you a random example, okay? So maybe the average difference is $2. So the mean is $2. But what is the standard deviation? Maybe the standard deviation is like $1 or something like that, okay? So then what you look at is, then you start looking at 3 sigma, 4 sigma, 5 sigma, the 6 sigma quality control. So if the difference is historically just $2 with a standard deviation of $1, and then you start looking at multiple standard deviation, and you see a big difference between the prices. Maybe suddenly the difference is becoming very big. Then what you do is you bet on the two differences coming together again, so becoming more normal, okay? So that's what you do. In this case, if the price of GM goes up a lot and the price of Ford has not gone up that much, but historically they have always been together. So in this case, what you say is that eventually they will come back to the normal part, normal difference. So you will sell GM and buy Ford, because the price differences become too much compared to the historical norm. So the basic idea behind, and then you can refine this in many ways, but the basic idea is statistical arbitrage is this, that you look at the historical data, look at the standard deviation, and then if it becomes abnormal, the deviations today become very abnormal compared to the historical norms, then you sell the one that is higher priced, and then you buy the one that is lower priced, okay? But again, this does not remove market risk. So that's why this is not really a CRA, but people call it arbitrage. It's called stat arb. So it's also referred, because people might use lingo. Okay. Sometimes this is referred to as okay. That's the lingo. Okay. So I'm giving you some kind of a brief background into these strategies, because it's good for you to know about these things. These are legitimate investment strategies. The only thing is, they are not actually CRA. So we should not have used the word arbitrage to describe them. And that's why when we're discussing arbitrage, I'm telling you what you might hear in industry and what is not CRA. So these are legitimate strategies, so you should have some kind of idea about them. So that's why I'm giving you the idea. And the reason they use the word, they should not have used this word, but the reason they attempted to use this word is you will find that in all these cases, they are buying one and selling the other. So there is no net position. Yes, there is no net position generally, okay? But there is a market risk, so they should not have used the word CRA. So, and profit is not locked in, okay? So therefore should not have used the word CRA. So you understand what risk arb is? This is also called risk arb, okay? Risk arb or merger arb, both. So you'll see, you'll understand. So arbitrage, people just say arb for arbitrage, so you'll understand what that means. Now the third one is, the third example of so the third example of the use of the word, these are very common transactions, okay, which are used in the markets. We have these kind of, which are referred to with this kind of labeling, which is not correct. So uncovered interest arbitrage is also, okay, also this is actually an FX strategy. Okay, it's an FX market strategy. So FX, I'm using FX as a short form for currencies. Okay, so this is only used in one asset class, which is in currencies. So if we have this as an FX strategy, this is also called or carry. You might have heard this trade, carry trade. Okay. So uncovered interest arbitrage is a term that is used to refer to something which is also called a carry trade. This is only a foreign exchange market strategy. So I'll give you an example of this. Let me get rid of this. Notice this. Okay, let's look at one market where we had people losing a lot of money because of carry trades. Right, so we can explain this, but I'll just maybe give you a longer term chart just to get a good idea. Right, okay. So you can see here, we split it out a little bit. This is, maybe they don't have the data. Do they have it? They don't have the data. Okay, so here what has happened is that people have historically tended to, so here in carry trades, we'll just briefly explain what carry trades are. Uncovered interest arbitrage, carry trade, we'll just call it a carry trade. What is it? Essentially what you do is you buy, so you compare, these are two currencies, so in each currency, of course, anywhere you go in the world, you can find out what the interest rate is on each currency. So you can either look at the treasury yield curve, or you can look at the bank deposits. In India, you can look at bank fixed deposits. Okay, what is the interest rate for 3 months? What is the interest rate for 9 months? What is it for 1 month? So you have different interest rates for different tenors, and in any market that you go to, so for every currency, there's going to be an interest rate curve. Okay, either for bank deposits, there'll be an interest yield curve. Okay, there'll be a yield curve for any market, any currency, that you can have either for bank deposits or for treasury securities. So you can look at that. And and then you can compare the interest rate. So historically, what has been the case is for many years now, Japanese yen interest rates have been quite low. And for a time, Australian dollar interest rates were quite high. So the difference between the two is quite big. So many people, what they did was say maybe Australian dollars are paying like 5%, and the Japanese yen is paying like less than 1%. Okay, so what they did is they borrowed, let's say take Japanese yen as 1% and Australian dollar rates are 5%. So what they did was they borrowed in Japanese yen. Of course, you can only do this in convertible currencies. You can't do this in the Indian rupee because it's not freely convertible. So there are capital account restrictions. But in the major countries, major currencies in the world, Australian dollar, Japanese yen, Canadian dollars, US dollars, Swiss francs, British pounds. Here you don't have all these kinds of restrictions. So what people did was they borrowed in yen and paid a 1% interest rate, and they took those borrowed Japanese yen and they sold it in the spot FX market, in the Aussie yen spot FX market. Here you can see Aussie yen. Aussie is the base asset and yen is the terms asset. So now it's around $78 or something. Okay. It's around 78. Okay, so 1 Aussie is equal to 78 yen. So it's not $78. 1 Aussie is equal to 78 yen. Back here it was worth about 105 yen. Now it's worth around 78 yen. Okay. So the idea was this. So let's say I did this when the Aussie yen was at 105. Okay, so I bought Japanese yen and I sold Japanese yen, but I borrowed Japanese yen. And so when you borrow Japanese yen, you get a flow of Japanese yen in your account. The bank disperses the loan, you get the money in your account. And so I take that Japanese yen and I go to the spot FX market and I sell the Japanese yen and I buy Australian dollars. Okay, so the spot Aussie yen market, what is trading? Two assets, Aussie dollars, Japanese yen. So I ask the dealer for a price and he quotes me Aussie yen bid offer, and since I'm buying Australian dollars and selling Japanese yen, I will have to hit him on his offer price. So I hit him on the offer price and I buy Australian dollars and I sell the Japanese yen. So now I'm long Australian dollars and Japanese yen at a price of 105, when 1 Aussie is buying 105 Japanese yen, right? Now, so let's say I borrowed 105 Japanese yen and I bought 1 Australian dollar. And then I took that Australian dollar which I bought and I put it on deposit in a bank in Sydney. Okay, or I can, we can talk about Euro markets. You can do it even in London actually. But let's assume that I use a bank in Sydney. So I put the Aussie dollars on deposits and I'm very happy because I'm earning a 4% spread. My cost of funds is 1% and my return on funds is 5%. So I'm earning a 4% spread, so I'm very happy. But then what happens is that the Aussie yen starts to decline. So remember, I have only 1 Australian dollar and I have given my 105 Japanese yen for 1 Australian dollar, but now it starts to decline. And let's say I put that on deposit for 1 year. Let's say for the sake of argument, you can put it on deposit for any tenor. I put it on deposit for 1 year. But now what is happening is it keeps declining. All right, it keeps declining. And of course, this is more than 1 year, but you can see here, if we just take this, so 75, it comes down very soon. Let's assume at the end of 1 year, it's down at 75. So now I've got a problem because my Aussie dollar deposit matures. Okay, I've got some return on it. But if it's gone down from 105 to 75, you can see already the decline is much more than 4%. So I had a 4% interest spread, okay? And that's what is called the carry. So when you say carry trade, the carry is actually 4%. In this example, the carry is 4% because that's the difference between your cost of funds, and your return cost of funds is 1, return on funds is 5%, so the carry is 4%. But I got a 4% carry, but my asset price depreciation is so much, 105 to 75. Now what happens? I go and get back my Australian dollars after my deposit matures. Then I sell it in the Aussie yen market to get back my Japanese yen because I have to repay my loan. But here, when I give back my one Aussie dollar, one Aussie dollar plus my interest, okay, so for $4, okay, so 1.04, then 1.05 because I'm earning 5%, and then I could exchange that for Japanese yen, but I'm getting much less than 105 yen which I paid initially. Okay, so I'm losing money. So I'm losing money big time because the asset price depreciation has completely wiped out my interest advantage. Okay? So this happened to a lot of investors in the Aussie yen, where there was a sharp down move in the Japanese yen, and then people lost money. So this is an example of, so obviously you can see that this is not free of market risk. Okay, so that's why this term should not be used to refer to carry trades, because they are not free of market risk. Okay? So that's the idea. So there are 3 of these that we just discussed, that 3 examples of, these are legitimate strategies, so you should know about them. You should have some idea about what these are, so that people ask you, you can talk about them. But you should also know mainly that the use of, what is common to these is that the use of the word arbitrage is not appropriate in these cases, because these are not CRA. And we had to come up with this term called CRA because people have started using the word arbitrage in a casual manner and using it to refer to transactions where this condition is not satisfied. So that's not allowed, should not be done. But yeah, that's not how the market operates. They're not that particular. So, but here we are particular because we're studying theory. The reason that you're an MBA, one of the advantages of being an MBA is that you have the right theoretical knowledge, but you also know how people talk in the industry. So you can, you can talk at both levels. You can use the lingo of industry, but you should also understand conceptually that this is not correct. Okay. So you should also understand conceptually that this is not the correct lingo, should not have been used. What is CRS? This conceptual clarity also has to exist. This is one of the most important features of studying for an MBA. Where you are a postgraduate finance student, so you have the theoretical knowledge as well. You have conceptual clarity, and yet you can operate in the real world. Okay, so we have studied. Okay, so we have not managed to finish this whole thing, but we started with the idea of synthetic equivalence, very important idea. And you can read this chapter, I would suggest. You can read it, it'll be very good. If you read the option, at least get a flavor of what he's trying to say. You don't have to understand everything, just new concept, complex ideas, reading them for the first time. You don't have to understand everything, at least get a flavor of what is being discussed. Okay, so the class is dismissed, and those who have issues those who have conceptual questions can stay back. Aman should also stay back. I'll discuss his problem with him, what technical administrative problems he's having with the software. Okay, so I'll come.
Yes, sir.
So your question, anybody has including Aman, if anybody has a conceptual question, then I'll include that in the recording.
Yes, sir.
Okay. All right. Okay.
Sir.
Yeah, Vipul, yeah, go ahead.
Sir, my question is, sir, I'm doing, sir, the project trading in, sir, trading TWS. Sir, I buy a call. Sir, sir, so what is the, sir, ideal time for which I can do or hold my call?
Okay, so you're asking, the question is about the ideal holding period. Let's put this in the session notes. So the question is, we have discussed about synthetic equivalence, we'll write that. The second question is about ideal holding period. So this also, remember, the reason I'm talking about all these terms is I want to make sure that you have the right You always use the right lingo. Okay, so the ideal holding period is. So the rest of the class can leave actually. Whoever is not interested in the discussion can leave. I'm not asking you to leave. I'm just making it clear that I'm not holding anybody back. Those who have questions and those who want to stay for the discussion of the questions can stay. Okay. Ideal holding period that he's asking about. Okay, for positions. Okay. So here there is no, there's no ideal holding period as such. What you have to look at is essentially this, that let's say, let's put it this way. You're buying and selling options. Okay, what is this? Which underlying is this? This is for Microsoft. Okay, so you're buying and selling options. And so let's say you bought call options. You bought call options, maybe you have bought call options because you feel the underlying asset price is moving up. It's going to be moving up in the future, and the IVOs are going to go higher. Okay, that's why you bought call options. Now, if it's moving in your favor, at how long should you hold it? Well, there's no formula for that. It basically, the logic is that you have to decide. And why did you go long? You went long because you thought this was going up and you thought this was going up. Okay. Now, at some point in time, if you feel that this is no longer going to keep going up, or this is also not going to go up, keep going up, one of the two. Either way, if your original bullish view is no longer, it no longer prevails, then you would want to liquidate your position. So that's what you should be guided by, your view. So it's like your market view that you use to take a position initially, that view has to be continuously sort of refreshed. That means every day, ideally every day, maybe sometimes several times a day, you have to rerun the whole analysis algorithm that you've applied and keep asking yourself, okay, what is my view now? Okay, 6 hours ago that was my view, but what is my view now? Similarly, every time you have to, several times a day, at least once a day, you have to keep asking yourself, what is my view now? So the moment that you're no longer bullish, that's when you sell your option position, because, I mean, assuming you initially bought. If you initially sold, then the moment you're no longer bearish on that particular option, okay, then you square your position. So that's the answer to your question, Vipul. There is no there's no standard formula. It has to be, you have to be driven by your view. Okay, does that make sense?
Yes, sir. It's depend on me, like whether I have to go, whether I have to wait or I have to sell. Okay.
Yeah, and view has to be taken. It's like taking guard in cricket. Okay, it's like after every ball you're taking guard, taking a fresh guard. So view has to be taken afresh. Okay, I'm writing it in a very strict way, multiple times a day, if required. Depending on how fast the market is moving. If the market is not moving, here, if I have a view on Aussie yen, okay, and my view, let's say, is bullish, but the market is just kind of hanging around here, it's not really moving, it's hanging around maybe here for 2 days, 3 days, 4 days, 5 days, then I will keep looking at it, but I will not change my view because there's not much market price movement. But the point is that I have to keep coming back and looking at the market several times a day if necessary. Okay, so that's the whole point. You keep refreshing the view and then driven by your view. If you are no longer bullish, then you sell. If you're no longer bearish, then you buy back. Yeah, is this clear now, Vipul?
Yes, sir.
Okay.
And sir, one more question, sir.
Yeah.
Sir, sir, I'm buying options for Apple, and sir, I am buying a call and put at the same time.
Okay.
And sir, for the same strike price. Sir, will it be a neutral position or there will be a risk involved?
So if you're buying calls and puts at the same time, actually what you're doing is basically it's a position like it's like almost like a strangle position. Okay. So if you go back to your CME booklet, the CME booklet, I closed it here. If you see the CME booklet that I've shared with you, There are some positions that if you're buying, you have to understand what you're doing. If you're buying both calls and puts, that means that you don't have a view on the underlying asset. You have a view on the eyeball. Okay. If you had a view on the underlying asset, you would not have bought both calls and puts. You would have bought one of them. But you're buying both calls and puts, which means you don't have a view on the underlying asset. But you're buying, you're not selling. That means you have a view on the eyeball, which is bullish. So if the rest of you, what you can conclude from Vipul's actions is that if he's buying both calls and puts, and he's buying options, not selling them, that means his view is he has no view on the underlying, no clear view, but he has a clear view on the eyeball direction, which is going to go up. That's the meaning of what you're doing. Okay, so always go back to the matrix that I gave you. That matrix should guide you in your decision making. What is your view? Set up this chart. Look at the underlying asset price. What is your view on the underlying asset price? You may not have a view. Then what is your view on the eyeballs? Then based on those two, put yourself in the matrix box and then do your transaction accordingly. Then you have a couple of other decisions to take. Expiration date and strike price, right? So does that make sense, Vipul?
Yes, sir.
Yeah, that means you're bullish on the eyeball. You have no view on the underlying asset. Okay. Yeah. Any other question?
Sir, sir, if I'm squaring off my position in options before I exercise them, so I'm not getting any time value, right? If I'm not getting any time value, so do I need to look at the eyeball?
No. 1 sec. What did you say? I thought you said that if you're squaring your position in the option without exercising it, right?
Yes, sir.
Yeah. So that, as I've told you guys, you're not supposed to exercise anything in this project. And anyway, early exercise is generally not optimal. So remember that you are actually capturing the whole idea behind that. If you go back to the part where we discussed, I think not too many sessions ago, we discussed this idea of early exercise.
Yes, sir. We lose the time value for that.
Yeah. So what Gaurav is talking about is these two. After, you see, we are talking about the decision problems. Okay. First, you look at the underlying eyeball index, and you decide whether to buy or sell options. And you look at the underlying market, underlying asset market. Okay. Maybe we should clarify this underlying asset market. Then you decide whether that buying or selling should be in calls or puts. You form a view on that. Then you decide which expiry date, then you decide which strike. After you bought the option, there is another problem, another DP that you have to solve. That is, should I exercise it early or should I square my option position in the market? And the answer to that, as I said, is 5.2, because 5.2 will capture the time value. 5.1 will not. Okay, so this will capture the time value. So you have to generally do this. So your question, from what I remember of the question, is your question actually, what you're saying is not correct. Because I think you said that if we square the option in the market, if we do 5.2, then we don't capture the time value. No, actually that's
okay. I must have got confused.
Now you got it, Gaurav?
Yes, sir.
Right?
Yes, sir.
Yeah. So that's why. Yeah. Okay. Anybody else?
Sir, is there a way that I can form a portfolio sort of things for volatility charts like we do in the shares? Like we can create our own portfolio and we can assess that what is the price going on.
No, I didn't understand your question.
Sir, like this is for Microsoft. So is there a option that in one of these websites that I can create a portfolio of all these tickers, so that whenever I want to look, I can just hover around that and directly look at?
I'm not sure about that. I've not seen any such. I think what you're talking about is, can I get a multiple view?
Yes, sir.
asset view. Yeah. So you can do that in some of the other stock charts, charting website which I've given you, but that's for spot stocks, not for options. So there may be possible. It may be possible. I'm not aware of it. You have to look at. This is a software display kind of question, right?
Yes, sir. Yes, sir.
Yeah. So yeah, I think you have to look around and see. But generally, that's not very useful because I mean, you can, of course, it's useful in what you are looking for. Essentially, if I understood you correctly, is you want to have one giant screen display where you have this one for Microsoft, but a similar one for Apple, similar one for Twitter.
Exactly, sir. Yes, sir.
Right?
Yes,
Just
sir.
like I can see all the students in one giant box there. Everyone has a box. Gaurav has a box. Rahul has a box. So, like that. That's what you're looking for, right?
Yes, sir.
Yeah. So I'm not aware of it directly of any such thing, but maybe it's possible. Maybe there is some software which allows you to do that. Maybe even a paid version of this software might allow you to do that. Okay. But another way you can look at it is for if you're looking at general trends. If you look at, say, this, if you change this to QQ, to the NASDAQ 100 ETF, so essentially that gives you a broad idea of what is happening in the cases of options on a range of tech or a basket of tech stocks. Okay, so this thing that you see, this movement. So you can look at this clearly and say that after the COVID pandemic, tech stocks in general are doing very well. How do you say that? Because you look at this ETF, which is tracking an index of tech. You don't know what is happening to Microsoft individually. You don't know what's happening to Twitter or Facebook or Intel, Micron, etc. individually. But you can look at an index which includes many of these major tech stocks. And you see that the ETF which tracks that index, which is basically the price of the index itself, that is going up. So you know at least that the tech stocks in general have been going up quite sharply. Okay.
Okay, sir.
So and then you can look at the eyeballs for those tech stocks. And you can
Okay,
see
sir.
there's a sharp collapse. You see there's a very sharp collapse here. 45. This was obviously, I think, the pre-election. People bought options pre-election, and after the election, things have collapsed. Okay, so this is going up. As you see, underlying asset price going up, eyeballs are falling. So you can use a basket to proxy that. Yeah. Okay.
Okay, sir.
Okay, so all questions are over. So I'll just go to Aman then for his discussion about the. I'll just stop the recording here. One second. And I'll stop the recording.